Hello, my name is Evan, and welcome to Economics 101, your number one source for everything economics. What if I told you that the US economy just added more jobs than expected, but economists are still worried? So in April 2026, job reports came in hotter than expected, with the economy adding 115,000 jobs while unemployment stayed at 4.3%. Now, on the surface, that sounds like pretty good news, but once you look underneath the headline numbers, the pictures become a lot more complicated. So today we're going to break down what the April job number reports actually showed, while Wall Street and the Fed are watching closely, and whether this means the economy is stabilizing or slowing down. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdowns of economics, please hit the like button and subscribe so more people can find the channel. Now let's go ahead and let's get into the topic. So here's the headline. The U.S. economy added 115,000 non-pay farm payroll jobs in April 2026, while the unemployment rate stayed unchanged at 4.3%. Economists were expecting close to around 55 to 65,000 jobs, so the report actually surprised a lot of people. Now, normally when job growth beats expectations, markets celebrate because it's suggesting that the economy is still expanding, and that's exactly what happened initially. You had stocks that moved higher. You had treasury yields that dipped. Investors felt a little bit of relief, but there is a catch. Even though you got $115,000 jobs sounds strong compared to forecasts, it's still much slower than the pace that we were experiencing a couple of years ago. This isn't a booming labor market anymore. This is more of a labor market that is cooling, just not collapsing. Okay, and we have to understand that. So when you look at where the jobs actually came from, things get a little interesting, right? So you had healthcare that added roughly 37,000 jobs, transportation and warehousing, 30,000 jobs, retail added another 22,000 jobs. That tells us consumers are still spending enough to keep retail and shipping active, but several areas of the economies are still struggling. Okay, so the information sector, especially when it's tech related employment, lost jobs again. Government hiring, it also weakened. And manufacturing remains soft, and higher borrowing costs and weaker global demand continue to pressure many businesses. So this wasn't broad-based economic strength; it was concentrated strength. Look at it as certain sectors and certain industries had growth, but a lot of areas struggled. Okay, that distinction really matters because if only a few industries are carrying job growth, the economy becomes more vulnerable to shocks. All right, here's where economists start getting a little bit nervous. The 3 month average for job growth is now sitting around only 45,000 jobs per month. That's a major slowdown compared to previous years. Labor force participation also slipped slightly. And while layoffs remain relatively low, hiring itself it is slowed dramatically. Okay. So economists have started describing the current environment as, and you'll hear it in the news a lot, but low hire, low fire. Okay. That's kind of the environment that we're in right now. So in other words, companies aren't aggressively firing workers, but they aren't aggressively hiring either. That creates a kind of a frozen labor market. And frozen labor markets can eventually weaken consumer spending. That's why a lot of economists are paying attention because consumer spending can ultimately be affected by what we're seeing in the labor market right now. If workers feel uncertain about job security, they tend to pull back. They spend less money. And remember, consumer spending drives about 70% of the U.S. economy. So even a modest labor slowdown is going to send ripples across the entire economy. And we're going to shift now. Let's talk about the Federal Reserve, okay? And their part in all of this. So the Fed they're in a difficult spot right now. They've been in a difficult spot for a long time. Inflation is still elevated. Energy prices remain volatile, and geopolitical tension are adding uncertainty to the economy. And at the same time, the labor market hasn't fully broken. Okay, so that means the Fed probably doesn't feel pressure to cut interest rates immediately. Okay, that's more important because investors have been hoping or anticipating rate cuts. A weaker job reports a weaker job report might have pushed the Federal Reserve closer toward cutting rates, but this report gives them cover to wait even longer. Okay, so that's why many analysts now believe rates could stay higher all through 2026, and maybe halfway through 2027. Okay. And if rates do stay high, that means your mortgage costs are going to be elevated. Credit card debt remains expensive. Business investment slows down. Housing activity weakens. So you can kind of see the ramifications for having higher rates or not cutting rates. The labor market is basically the Fed's scoreboard right now. Okay. As long as unemployment stays relatively stable, policymakers can justify staying cautious. All right. Quick pause, guys. If you want more breakdowns like this, covering inflation, job reports, recession risk, and everything that's happening with the Fed, make sure you subscribe and please turn on your notifications. These economic reports move markets really fast, and the channel helps. And this channel helps simplify what actually matters. Now back to the video. So where do we go from here? What's happening next? Okay. Right now, the economy looks like it's balancing on a tightrope. Yeah, for the most part, um, we're seeing right now slower hiring, like I said before. Inflation still sticky. We are still seeing higher energy prices as well as elevated interest rates, but we're not seeing a major recession. Okay, at least not yet. At least not yet. Okay, this is what economists call a soft landing scenario, I guess. The ideal outcome for the Fed is inflation falls without unemployment exploding. And so far, that's sort of that's kind of what's happening. But risks are still building beneath the surface. That's why it's so important for us to break down videos like this so that everybody can understand. If consumers start cutting spending, and I think that's the biggest thing we got to worry about. If consumers really start cutting spending or businesses lose confidence, the labor market could weaken much faster later on in 2026. That's why every monthly jobs report matters a lot right now. One week report won't change everything, but a trend it absolutely will. So now I'm going to give you the big takeaway, the bigger overall picture on all of this. Okay, just break it down what we just went over. The April 2026 job reports was better than expected, but the labor market is clearly slowing compared to previous years. The economy added 115,000 jobs. Unemployment stayed at 4.3%, and the Fed now has another reason not to cut interest rates, okay, or to keep rates elevated for a little bit longer. The big question now is, can the economy cool down without tripping into a recession? Let me know what you think in the comments below. Is the labor market stabilizing, or do you think we are starting to see cracks, or we've been seeing cracks? And if you enjoy this breakdown, make sure you like the video, subscribe to the channel, and share this with someone trying to understand what's happening in the economy right now. This is Economics 101, your number one source for everything economics, and I'll see you on the next video. Thank you.